Hello, everyone. Welcome to another episode of The Clueless Capitalist, where we discover interesting startups, interview founders, and help you become less clueless with angel investing. My name is Razi.
And I'm Osman. Welcome to The Clueless Capitalists.
In this episode, we have a returning guest. We're going to be speaking to Hishabee. Hishabee is driving digital transformation of pen and paper SMEs in Bangladesh. And joining us once again is the CEO and co-founder of Hishabee, Rakin. So welcome to the episode, Rakin.
Hey, thanks for having me here again. It's good to be here again.
So it's been almost 1 year since we last spoke, and we just reconnected again at South Exchange, and you shared with me all the exciting things that has happened and is happening at Hishabee. So we'd like you to bring us through your updated pitch deck, and then we'll ask you questions from there.
I'm a two-time founder. I'm a software engineer guy by my degree, but all my life I've worked in startups. That's either as an employee or as a founder. And right now I'm working on building Hishabee. And at Hishabee, we are driving the digital transformation of pen and paper SME. Bangladesh is one of the fastest growing economies in the world, yet 93% of Bangladeshi small businesses still relies on pen and paper to run their operation. As a result, these businesses face severe bottlenecks, hampering their overall growth. Let's take a moment and focus on the diagram that we hear. This is a high-level diagram of the supply chain of how it's working. And on the left side focus, we have distributors. So distributors in this definition are businesses who are supplying products to retailers. Distributors manage sales representatives and has to fulfill deliveries. They need to track products being returned and damaged or worse, stolen. And as a result, they spend 3 hours on a daily basis trying to reconcile their inventory, and yet they're not sure if they're even doing it right. On the retailer's end, these businesses need to keep track of their customers' credit and dues. They need to reorder stocks and often unaware of which products that needs procuring. Ends up losing unclaimed credit to and ordering the wrong stocks during procurements. A common problem that unites these businesses is access to finance. So these businesses, which 57% of the Bangladesh's economy in this space, is part of an informal economy. So being a part of an informal economy, these businesses often revert back to loan sharks or like informal sources of lending, paying 5 to 6 times more interest on this informal credit. And that's where we come in. Hishabee enters the user's journey by enabling end-to-end digital record keeping. So we have two platforms, Hishabee Paikari, which in Bengali translate to distributor or somebody who sells in bulk, a distributor management system, and Hishabee Dokan, a retail management system. So we take care of everything from sales, expense, purchase tracking, bookkeeping, inventory management, and everything else. On top of that, we give users management analytics so that they can manage their business with better data-driven decisions. And right now, what we're doing is building embedded access to finance. So when a retailer needs to purchase products from a distributor, a retailer don't need to pay upfront. They can get the products from the distributor, and we, working with our lending partners, will finance the purchase in an invoice finance, and the retailer will sell the products off and pay us or the lending our partners back. And this is what we're going to enable. So an embedded access to finance from our existing tool stack. Bangladesh has 7 million micro and small businesses in this space, and taking a top-down approach of the SaaS marketplace and the lending opportunities, the total addressable market is 60 billion. Our SAM is the segment with a smartphone, and within our specific age criteria, making it 25 billion. And this SAM is growing 8.5% year on year as smartphone adoption is growing. And from there, our SOM is 2 billion. That's the percentage of users that we are able to currently convert from our existing historical data. Till now, we have established 3 revenue channels. In the SaaS side, we operate a freemium model. Users can get started for free, and then we upsell subscriptions. 60% of our current revenue is being generated from subscriptions. The rest 40% is generated from upselling value-added services. So these are one-off sales that maximize customer lifetime value. And as mentioned before, we are piloting an embedded finance product that will enable invoice financing. This is where we are gonna take 20 to 40% of a profit share that these businesses are taking these access to finance on. While being a pre-seed startup, we have made substantial progress in both user growth, product development, and revenue generation. We have been able to acquire 230,000 businesses into our platform. Our CAC to lifetime value is more than 10 times, and we have an 80% gross margin on the revenue that we're generating. We have tripled our revenue in the last 6 months, growing consistently on an average of about 20%. We have positive unit economics, and we're aiming to be profitable by Q2 of next year. The reason why we have such strong early traction is because of our go-to-market. Our distribution channels reaches most rural villages, and we are able to drive technology adoption. Apart from digital ads, which is our current primary distribution, we also deploy our own reseller network of 200 plus agents. So we have recently launched Hishabee Paikari and Hishabee Dokan. That's the two record keeping solutions that we're working with. So this year's focus is to release the marketplace in a beta launch, and in the following year we're working on releasing the supply line credit, which is invoice financing, and our alternative credit rating to build on the model of automated lending access. We're growing fast, as mentioned before, that we are expected to reach profitable by Q2 of next year, while deploying all pipeline products by end of next year, and then start rapidly supercharging our growth. We have created a unique advantage in this space because we operate from 2 points. We can serve as more credible and increase accessibility in the market, because we are working with distributors, we're working with retailers. So that does a natural flywheel onboard effect. Already we can see in the market that's going on. And we can leverage an ecosystem of tools and services that interconnects with each other, making our app distribution far more advanced than any other player in this space. We are currently seeking $500,000, $250,000 to reach profitable, and another $250,000 in strategic investments. Till date, we have raised $330,000 from Accelerating Asia, Angel Invest, and a few other angel investors and SMEs. And the founding team consists of me, Rakin, my twin brother Zahin, and Ratul. The three of us have previously built another startup together. We have worked in different industries. Our chemistry is exceptional. And in the impact side, we have helped over 13,500 women entrepreneurs run their business from home. We have recorded over $10 billion of sales in our record-keeping solution. And we work with 12 partner integrations. This includes bKash, Paperfly, logistics suppliers. So we bring all other services into one platform, enabling access to services.
Well, it's amazing to see the growth over the past 12 months, or since we last spoke. I was very curious to know about, because when we first spoke in the previous episode, you talked about what we saw was the Dukan app.
Right.
And we have Paikari. So share with us, how did Paikari come to be?
So it's a very interesting finding that we found. 43% of our subscribers turned out to be distributors. So if you think about that, why are distributors in a retail management solution? So it's not built for them. And why is there such a high conversion of distributors in our platform? We started our conversations with distributors. We started calling them, we started doing interviews, trying to figure out what are they doing here. And then we figured out that a distributor needs to manage sales representatives, needs to manage deliveries as well. So imagine a product, and imagine you, a distributor, having 5 delivery guys in cycle vans going around delivering products. And each route that these delivery guys are going has like 100 retailers. So 5 into 100 would mean like 500 retailers that you are having to transact with. Each of these retailers has an account that needs to be managed. Each of these retailers are giving back products which are unsold, maybe expired or damaged, and that needs to be sent back to the supplier. So the entire movement of product is extremely cumbersome to do it on pen and paper. Like me, myself, have been and visited these distributors. They have like stacks of papers of like invoices, of order slips, and it's insane how messy that entire operation is. And there's a huge leakage in like miscalculations. They're missing out on products. They're completely unaware of how much product is exactly in their storage unit, what is the value of products stuck in damaged products or like expired products. And these needs to be sent back to the supplier. So because of they're in so much pain and excruciating pain, they are reverting to a retail management solution to solve this problem. So that's what we analyzed, that the market is big enough. There's plenty of distributors and sub-distributors in this space who are having to go through the same process, and they don't have one solution that helps them keep track of the movement of inventory. So that's when we decided that, hey, the baseline product is still inventory management, still bookkeeping, or still accounts management, cash flow management. The user experience needs to be a little different, because it's no longer like a pocket point of sale. It's the user experience is that you're assigning products to a delivery guy. The delivery guy is going, delivering products, coming back with products. So that's why we decided to build a different front end for Paikari and a different front end for retail. And that connects to the centralized backend system that we already had. So now a distributor can, or like a stockist or a sub-distributor can use our platform and manage their entire business. And we already have the retail solution. So why did we choose to make two platforms? Is number one, that it creates like the brand and the focus or the messaging of the product is simple. People are not confused, like, hey, is this product for me, etc., etc., etc. So we have simple go-to-market strategies for both. The messaging, the content, the advertising can be simplified to target that business and get high conversion. And on top of that, this increases a natural flywheel, because every time when a distributor is selling to a retailer, we are able to send a digital receipt. And in the digital receipt, we send a link to install our retail app, and vice versa. So every time a retailer is purchasing and tracking a purchase in our Hishabee Dokan app, that, hey, I bought XYZ from this supplier, we send a message to the supplier automatically, hey, this is what you sold to this retailer, why don't you download this app, the Paikari app. So this is already generating free user onboards for every transaction that goes out. On top of that, imagine you're a retailer, you're getting messages every day from your distributors, download this app, download this app, download this app. So that infuses stickiness either way. Like, we are in their head all the time.
I think there's one thing that Osman likes to talk about where he says, look, what you invest in today is going to be very different from how the startup will be months down the line or years down the line. And what you've done is you've listened to what the market wants. You've seen how the users were using the product, and you've created something that matches this other group of users. I think that's really powerful. And now you built up this entire ecosystem, which was not there when we were speaking a year back. Very impressive.
So yeah, let me just emphasize on that particular point. When I talk to startups, everyone talks about, yeah, we saw this problem, we pivoted and we did this. In larger organizations, that's just not possible, right? So let's put that into context. If this was one of the telcos that I was a product manager for before, what typically happens is we look at the market, we evaluate what's out there, we then see where the competition sit, we see where we could probably sit, and then we would go and request a budget to develop the product. That takes a year, and the market's probably moved on by then. And then by the time we go and start to build the product, that's going to take another year, 6 months if you really push for it. But we're talking about, delivery, training of the salespeople, training of a channel of salespeople, getting all of that done. And then you would do a big launch. But then even then, we're still not sure how we're going to bill for it and how we're going to collect the cash. So there are all these processes, and they all take like a really long time. And what you've done in such a short period of time is said, here's a problem, this is kind of what we're doing, let's just quickly change that and deliver it. We hear this from startups and founders regularly, and we just accept that, oh yeah, you solved the problem, you changed it. But when we're talking from big corporate entities, that process can take a huge amount of time, and to pivot in big corporate really is, there's a lot of inertia. We've just spent $2 million on developing this product to market, and now you're telling me it's moved on. You can't do that. Now you've got to just commit and move forward. So this is like an amazing thing which we take for granted, but I just needed to re-emphasize the point of how much market advantage startups have in the space. They don't have that level of inertia of sunk cost. Like, we've invested this much money, and startup founders forget this all the time. They just think, oh yeah, we're running against you're competing against other startup founders. You're competing against other startups that might enter the market. So you've got to be quick. Whereas the larger organizations, they just can't compete, not on this level.
What I've figured out is that the quicker you're able to adapt to market signals, and in the early stage, it's all about learning about the market signals and quickly iterating. And that could be a feature iteration of some part of the product iteration, or maybe go to market iteration, how we are messaging, how our contents are going there, our market positioning there. it's all about optimization. So once you're in that, like in that constant loop of like iterating market feedback, set up a feedback loop and iterate, you keep on like discovering more and start making more progress.
And this is a good example of lean startup where you are talking to your customer, you are beginning to understand what their problem is, and you're adapting and you're developing. So whenever people talk about pivoting, it's not failure. In fact, it's anything but. It's adapting it to a market fit and getting a bigger market fit based on what you're getting feedback from. So it's just a classic thing. And for angel investors, sometimes they delve too much into product and they go, oh, this product is not really blah, blah, blah. And oh, I'm not too sure. And it's like, do you trust the founder? Because really at very early stage, the founder is the key. The founding team is the key. Can they adapt and can they move quickly? Do they have the capacity to do this? That's what you're investing in more often than not. The product that you have in 12 months' time is very different to the one that you started off with. And that's just a reminder for other angel investors, if they're watching, to be aware of and not go down the rabbit hole of just evaluating the product. You're evaluating the team and the capability of the team. All right, so in terms of the ecosystem, can you just walk us through what that actually means when you say I've created a whole ecosystem? Just give us some classic examples of what that means and why that's an advantage for you guys.
Generally, we are working from 2 points in the supply chain. Like as mentioned before, we have the data, we have the access to the distributors, and we have access to the retailers. So what we're right now focused on building is a closed loop ecosystem. What we mean by that is that when a distributor and a retailer is having transactions between us, we wanna tap into that in terms of a distributor already has their inventory updated into our platform. We want to make it readily available for the retailers in that area to be able to browse and access more inventory and order from within our solution. And also, like I said, 57% of these mom and pop shops are in the informal economy. Means even if they want to get access to loans, this is the end of the month right now, you'd see the transactions right now is dipping a little bit because of people don't have that much cash on them right at this time. So during these times, what happens is that they need that access to finance, and their current opportunities right now could be an NBFI or an MFI or an NGO that they can go to, which takes 2 weeks, 3 weeks for the loans to process. Their cash crunch is already gone. They could not acquire the product. They could not sell to their customers because their customers are coming asking for a product. They don't have it stocked, so the customers are going to the next store to buy the product. So they lost the sale. In context, low-income FMCG retailers, the mom-and-pop shops, are losing customers because they're not being able to stock the products efficiently. And what we are focused on doing is that we're focused on building an embedded invoice financing opportunity, so that when they need to stock the products, we pay the distributor, and the distributor then gives the product to the retailer, and the retailer pays us back after 7 days or 10 days with profits that they're sharing with us, and then we pay that back to the banks or the lending partners that's working with us right now. So that's what we're building towards. It's just because we are already at 2 points, now focused on increasing connectivity between the 2 points.
And let's just talk about this embedded finance, because everybody in fintech, or everybody I talk to at fintech, talk about how this is going to create massive opportunity. But I just want to be the pessimist in the room, right? And say, hey, look, you're doing invoice financing. There's always a risk of default. Who takes that risk?
This is where conversations goes with your lending partner. But if you can negotiate a deal with your lending partner, I'm talking about the general ecosystem, not just ourselves here. So if you can negotiate a deal with your lending partner that risks are going to be on the lending partner, then no problem. But then again, a lot of these, let me just put to context, apart from being part of an informal economy. The other reason why banks or like other organizations don't like loaning out to these businesses is that the overhead to loan these businesses, like they're gonna take what, $5,000 of like loans, or like maybe $3,000 loan, which is very tiny when compared to a bigger business taking $100,000, like $1 million. So what happens is that, you know, the overhead to process these loans is the same, or almost the same. And then the unit economics of banks here, or like NBFIs here, doesn't make sense unless you can crack the entire process digitally. So and what gives us the unique advantage in this space is that we are able to cross-match data from distributors and retailers. And from there, we have already generated an alternative credit score. And right now we are piloting that credit score to see how effective this is, and then maximize and optimize our credit score on that before we do a full rollout of the invoice financing. Here comes the conversation again, like, are we able to lower down overheads for these banks to be able to give us those negotiation points? Because are we able to put a certain part of the portfolio in there? Are we helping them with the collections? So all of these points come into the conversation when talking about the default risk, and also how accurate the credit score is, and how does that factor into their existing credit score. So yeah, always there's a conversation to happen in this space in terms of who takes the risk of the credit that's going out.
In this particular case, it's the financing provider that's taking the risk based on you having done the appropriate credit scoring through the apps. Is that correct?
Right. For the pilot program, that's how we're going towards. But then at full scale, we need to then go into details of exactly how this is going to roll out.
Okay, got it. And I mean, you've talked about the 20 to 40% profit share. Now, just off the top of my head, I think that's high. Is that predatory, or is it a good deal? I mean, I'm speaking from context of, like, you know, Western lending schemes, right? Is this a good deal or not in Bangladesh?
A few things, because let me go back to who our users are. Our users are people who's part of the informal economy. So what are their access to loans right now is NGOs and NBFIs. Banks will not come here. So banks' current average loan is around 10%, maybe a little more or less. For the NBFIs or the NGOs, they're legally allowed to loan up to, let's say, 24% interest. If you put that into math, so 24% interest, and that's the people who's going to NBFIs, and then the loan sharks are like a lot more higher, like, you know, it's like five times more higher than the regular bank rates. If you put that into context, and if you divide, let's say 24% into divided by the number of months, so that's like 2% a month, and then that accumulates. And 2% would ideally mean, if you put into context again, into how much is part of the profit margin, that'd be around 10 to 20% of the profit margin there anyway. So ideally, what we are doing is, and as mentioned before, we're still piloting, and this could, at scale, this could vary from our profit sharing perspective. To put to context, what we are enabling is, and I would not say it's predatory, is that you're getting immediate access to finance when you need to. You don't need to wait 3 weeks to get it rolled out. And you're not accumulating debt over time. You sell the product off, you pay it back. You don't have accumulating debt on this anymore. You don't need, maybe right now you're at a crash crunch, you need that debt. You're paying it back off in 7 days, 10 days, maybe a little, and sharing a bit of profit, but you're not accumulating debt over time. And another thing here is that, because Bangladesh primarily is a Muslim majority country, and a lot of these businesses are not in favor of like accumulating interest, because it's not like allowed in the religion. So our model does not include an interest here. So they're just sharing profits. So that is another angle that we can tap into here, and that doesn't make it predatory.
Yeah.
So it's basically accessibility. When you need it, you get it, and then you're not incurring debt over time.
And that's really what I needed you to bring out, because most people see 20-40% and think, wow, that's terrible. But actually, in reality, what you're doing is you're increasing the velocity of money. We talked about this the other day with another startup, and And what you're doing is you're enabling this micro SME person to sell more product at a quicker rate without slowing things down. And yeah, they sacrifice some of their profit, but they're actually accumulating more sales. And the debt doesn't accumulate over time because they're only sharing the profit that they actually make.
Right.
It actually benefits everybody. Benefits you, it benefits the retailer, it benefits the consumer, which is great. But yeah, when you throw out a 20-40% number, you just think, wow, that's debt.
Right. So depending on the products you're selling, honestly, like in the FMCG space, the profit margins are not too high. So here we'd have to settle down with a profit margin. The retailers are open to sharing with us for the service that they're getting. So at the end of the day, they'll do a cost benefit, like, hey, this is the cost, this is the benefit. And if it matches with their requirements, only then they're going to take this service. So
I was going to ask a question. So I was just looking, so the last time when we spoke, we were comparing this to Buku Kas, to Buku Warung, to Khata books. So look, they seem to still be struggling. So how are things different in Bangladesh, or how are things different from the way you are going about handling this?
Primarily, I think it's all a matter of mindset. And that's my 2 cents on this. And it's not, because what we have always been monetization first from day one. Like, my philosophy here is that if I can't generate revenue from 100 users, I cannot generate revenue from 1 million users or 2 million users. So that's my philosophy in this space. So Khatabok, for example, have accumulated millions of users, and then there was always a question of how do you monetize? And we have similar players in Bangladesh space as well to get taken the same strategy. And also Baku Warung and Baku Bus, they have taken similar strategies here in this space as well. What we did was that from even the early days when we were running our MVP, we had a subscription model over there. And what we did was that we did not make our app completely free. What, let's say, a player in Bangladesh, Kalikata, just does like cash transactions and does like credit tracking, etc. This is free on their platform and also free on our platform. Where we monetize is the inventory management and the other add-on like services that we have that people pay a subscription for. So that's where we're generating our current revenue. And on top of that, we are upselling upselling consultancies, we're upselling our the partner services that we have, the 12 partner services we have. We upsell there and we keep a take rate over there. The only difference that we have is that we have a freemium model in terms of subscriptions, and you can look up, there are a few Indian startups that has a freemium model, and that's generating good revenue. A completely free solution in this space with the aim of generating revenue from this user base later is something that I hasn't been able to crack it yet in this space.
It's important that you brought that up because when I was looking at some of the other players that I've mentioned, they actually were giving the platform previously for free, entirely free, and then when they try to monetize it, that's where they really struggle. So it's great from day one. You have said, hey, this is not free, it's freemium. You get these 2 things for free. You have all these additional features you have to pay. And I like that you are on the path to being profitable soon.
Sure. Because if you brand yourself from day one as a free product, and after like 3 years, you're like, hey, you know what? It's no longer a free product. Pay for these services. Your customers are going to get really angry. We never branded ourselves as a free product. Everything you get in a free app, you get it free in our solution. Like, we don't compete there. Like, you get all the free services in another app, you get it free here as well. We have additional features that we have built out. For that, you're having to pay a subscription. So not like I said, we have like almost 50,000 monthly active users right now. And from there, about 70% is free users. Like, they are using it for free. And these free users, they did not feel the need to upgrade to a paying plan, regardless, but the rest did. So that's where we're generating our subscription revenue from. And we are able to, because it's a matter of being able to educate these businesses. Okay, you have this service. If you use this service, you get XYZ benefit. So that's where we are generating, like, once they're sticky in the platform in the free section, we are able to convert them in the paying section as well.
This goes back to like the guys at Waiter, for example, I can't remember whether they were in your cohort or the previous cohort, but these guys have never given freebies out, and they've had the market absolutely hammer them. They've been struggling to get to a point of profitability, but they've outlasted many of the competitions that have come in, taken their market share from Waiter and run out of money, and then they've had to come back to Waiter. Right. So these guys have just done the slow and steady wins the race kind of approach. They've just said, we're not going to compromise. What we're going to do is we're going to deliver value, and we're just going to try and defend our market. We will get natural attrition to people going for the quick freebies. And then when that runs out, then what will happen? Right. So, you start to see that, the grow at any cost, it doesn't work. You burn through your investors' cash, right? So, and the market changing, the appetite for investors to do that has gone now.
We've always been very capital efficient in terms of, like, even at this stage, our unit economics is like every dollar we're spending, we're making $2 back, $2.5 back in good months. So, like, that is why we can aim to be profitable in the next 7 months. We know our drivers, we know where to focus on to increase revenue, and we've been doing that. So, like, you can see in the last 6 months, we've tripled our revenue. And why just holding on to this momentum in 7 months, we'll be there. And then adding to this cumulative revenue, as mentioned before, we are adding the embedded finance angle here. That is gonna generate substantial revenue. On top of that, we have our other plans of our product lines as well in terms of accumulating revenue. So the trick, and it's my 2 cents here again, the trick in this space is to accumulate different revenues from the existing user base that you have. Yeah. It's not just going to be one subscription revenue that's taking you all the way. You need to accumulate multiple revenue channels here from the existing user base that you have. Okay. And that's what we have been doing since day one.
Let's just have a look at, it's a great segue, because we can then go and have a look at your metrics that matter, because the ones that really matter for you are your acquisition cost, your lifetime value of a client, your CAC to LTV ratio. We're beginning to see more of that in pitch decks now, and you've also talked about your path to profitability by Q2. So do you want to just run through the metrics that matter, and we'll do some follow-ons from that as well?
Yeah, for sure. So our revenue drivers, because primarily about 90% of our revenue, or a little more than that, is being generated through our telesales agents. So we know exactly who our ICPs are, who we need to onboard into our platform, and how to close these ICPs, what value proposition we need to sell to them. So just a high-level understanding of how we are operating is that when a user onboards into our platform, we assign it to a telesales agent. And this telesales agent works throughout the user's journey by providing the user with onboarding tips, and also pushes for a subscription model when the user is ready for paying a subscription. That's how we are currently at 24 agents. So we need to scale our team to 118 agents, and that's what we are focused on doing right now. And that's part of the fundraise as well. So once we secure the funds, we're gonna start expanding our team size. So at 118 agents, we cover all our costs, and then we will be profitable.
In terms of from a SaaS perspective, this is called customer success. Right. People will download the app, but will they use it? And that's where this for me is the hallmark of a good SaaS product. You've got, if you don't do a follow-up immediately with a client who's done the download, and you're not able to even identify whether they've done anything with it, then you're already on the path to failure. But if you've got somebody who's downloaded the app and you're following up with them to say, hey, we've noticed that you haven't done X, Y, and Z with it, tell me what the problem is. Yeah, you're eliciting feedback, but you're also making sure that they start to derive value from the product immediately.
Absolutely. We are literally driving the tech adoption here. Like they were pen and paper businesses and they've been doing it for generations. You need to be really hands-on to these businesses for them to drive. Like maybe 2 years, 3 years later, when the newer generation comes in, this is not gonna be as extensive. But right now, we figured out that regardless of what the Western market looks like, if we have to adapt to the market in Bangladesh, we have to understand who our users are, what are their current way of doing things, and then figure out a way to tap into their current way of doing things to be able to get them to transform to a new way of doing things. So that is exactly what we have done. So you'll get because we have an auto caller system working. So once you install the app, you'll get a call in 5 minutes. Within 5 minutes, you're gonna get a call from our agents, and they're gonna welcome you in the app, give you a brief information about the app, and then if you have some time, they'll book in a demo with you to show that okay, this is what you can do in our platform, and then from there, our average sales cycle is 3.6 days. So from installing the app to subscribing, in 3.6 days, a user is subscribing into our platform, and that is rather quick. And that's even before the subscription, the free trial expires. So that is what we have cracked till now, and we have to just focus on expanding that agent base, and just hit profitable, and then keep on adding that to that cumulative revenue.
And this is the other reason as well why you need to be quick, because it was highlighted in another market, like in Pakistan, where they were talking about the tech adoption. People have got smartphones, but they've got those low-end smartphones where the memory and the capacity for storage is really low. You download an app, you don't get much value of it, you'll delete it, right?
Absolutely. That's what we have done as well. Like we initially built some parts of our app using Flutter, and we identified that the build of Flutter was like 100 megabytes, and our CTO scrapped everything. He's like, no, nobody's gonna use it. So we reverted our tech stack to Kotlin right now for the Android one, so which is 16 megabytes. So we identified that they don't have space in their phone. If they're gonna delete it, they're gonna delete the app. So we have to make a way for ourselves in that space. That's what we did. We try to keep as minimal as possible, just to keep our sizes also in check. And not just that, also app versions. You need to be able to Android versions. You need to be able to cater to older Android versions as well. And that's where you face a lot of challenges in terms of a lot of library supports are not there, and that's not there. And we have to build a lot of those things out because we are not being able to integrate a library. So that's why, a lot of products from around the world has a struggle to come in these spaces and make the space. The primarily number one is that they don't exactly understand the nitty-gritty of these user base and what their psychology is, what their behavior is. And on top of that, and also another reason why Bangladesh is like a safe haven for local SaaS producers is that our Forex rules don't allow all people to pay for foreign software. You cannot do a USD transaction outside. So Zero can't come in, Zoho can't come in. So all of these are locked, and we are able to because I was just doing an analysis in terms of 93% of businesses who we talked to ended up on pen and paper. The rest 2% is on Excel, and there is 1% on competition. The rest 4 to 5% is on a competition platform that in the local space. So we don't have any foreign apps that's being able to come here and do drive any impact out of the space.
This is again what blows my mind, right? The more you ask, the more you begin to learn, and this is a clear demonstration of understanding your own market. This is why even if somebody came in from outside of a region to say, hey, we've got a solution for you, it just won't fly. It won't work. People download the app, think if they download the app, right, and if they get to download the app versus, let's say, a 16 meg file from you versus spending an hour trying to download a 200 or 300 meg file from somewhere else, and then it's not in the local language either. You've got to work out what to do with it, and they've got to do that themselves. The adoption is going to be terrible.
Yeah.
Anyway. Yeah. So
I think this is why Hishabee has so many of these videos to teach you how to use different parts of the app. Like they really made sure that the user knows how to maximize what the app can offer them and their business. So I like how it's got. I was just checking the YouTube channel, 171 videos now.
Yeah, we have a lot of videos for every angle of the app. This is how you do it. That's how you do it. We make a lot of videos.
Yeah. And that's exactly what we were doing at Blue Jeans. We would have a video that would outline how to do certain things. Even a recent onboarding session that I did with Aspire. I mean, as soon as I applied for the account guy had called me up and scheduled a meeting with a CSM. CSM then went through everything with me and then pointed me to videos to remind me how to do things when I did come across that. It's a hallmark of great success because I've now got an employee using the Aspire credit card and I've got it all set up the way I need it to be. It's all synchronized with Xero. It's brilliant. But I wouldn't have done that if I didn't have a call with the CSM. The CSM literally walked me through it and made sure that I prioritized it amongst all the other things that I was doing. So that's the other thing. Yeah.
I think let's move from here.
That's the human touch that needs to be there.
I was saying let's move into the fundraising discussion. So right now you're fundraising at a $6 million valuation, 500,000, and you already have 140,000 committed. And just to add, when we spoke to you a year ago, the valuation was 3 million back then.
Yeah, it was 3 million. So that was last. Not even a year. It's been what, 10 months.
So you've invested 10 months ago. You'd have already seen on paper.
On paper, 2x. Yeah.
And maybe you can tell us, like, what does the exit look like? You know, like now you're at 6 million. Where do you look to? What kind of valuation and how would an exit look like if someone were to come in on this round?
The angles that we are working with, there are a lot of possibilities in terms of if just taking a step back, for an exit to happen, we need to solve a crucial problem, not just for a user right now, but for a company. It's the same thing. To sell something, you need to solve a crucial problem. And if for a company, if you understand, companies in the FMCG space are having to manage countless distributors, manage countless sales representatives, and each sales representative then works with the retailers. So once we have the entire supply chain in a closed loop ecosystem, that gives them the leverage. Hey, there is access to finance in this space that they can leverage to push down their products throughout the supply chain to the distributor and to the retailer, getting data, getting a credit score on each of these businesses that's here. My understanding here is a potential exit to bigger FMCG brands who wants to maximize their operations. Let's say in Bangladesh, we have Bosundhara, we have Pran, really big brands. They want to leverage our tool stack. It's a very good exit opportunity to them. Other than that, we have an exit opportunity to businesses who wants to go more into the fintech space. We have the digital banks license coming out. And if there are bigger digital banks who wants to go into the entire supply chain transactions, their lending opportunities here, their savings and investment opportunities here, and bring in a full array of the banking products that there is, that's also an opportunity to come in here as well. Because we have, what makes or breaks here is that the user base that you have, and they're actively using the platform, they're getting existing value from the platform. That's where you can build huge businesses on top of this. And also you can an exit opportunity is right there, because like I mentioned before, there's fintech opportunities there as well, the supply chain opportunities there as well. So depending on whose problem we're solving at a bigger angle, that's where an exit would ideally work to come in.
When people ask me about my own startup and what the exit strategy is, I say it's too early to say. and I'll leave it at that. Only because I know that I also have investors who want a longer term play, and if I'm talking about exit really early on, it can kind of sour that relationship with
absolutely.
So, yeah, I mean, so we're not trying to put you on the spot there or
No.
anything.
No, that's cool. Because at the end of the day, we still have a very long way to go. We have big milestones to achieve, make a big brand that we are working with right now. At the end of the day, exit could happen in various ways. It's really hard to predict what an exit will be like at this stage.
Yeah.
But then there are potentialities, there are potential of the certain things that I mentioned. And that could go on, like even to like bigger brands like ShopUp or like working with other like FMC who's bigger in the FMCG space. That could be an opportunity there as well. So yeah, the doors are open for like a lot of things to happen. However, for us, we focus on building a good business, and like the opportunity will come on its own.
Absolutely,
Yeah. And this is like a 5 to 8 year time horizon, right?
Yeah. I mean, I don't know exactly what time the opportunity will arise, but then again, my focus right now is simple: build a solid business, high growth, and work on it.
Yeah, absolutely. I mean, once you do that, everything else falls into place. And if you're focused on your own growth and success, it will build on that. You'll just naturally get a great exit. But yeah, as with everything angel investing, you've just got to assume it's a 10-year play and hope for the best. Obviously, you are fundraising, and we will probably be doing a syndication round for this. So normally, if people want to have like an indication of how that would look like, just to learn how the structuring of the data room would look like, and have an insider view as to what the potential opportunity is, then if you're a member of the Clueless Capitalist, you can actually get an insight into how we're structuring that deal. And obviously the deal's only open to people who have got accredited investor status, so you've got to understand the risks. This isn't an invitation to invest. It's more around join our club at the Clueless Capitalist, and we'll educate you on how these deals work. And it's the only way to learn, is to peer over the shoulders of other people that are doing it. That's the best way of actually educating yourself to become a better angel investor. So if you're interested in doing that, why don't you just sign up and subscribe on our LinkedIn page, or drop us an email, like, comment, and subscribe. I don't know where I'm pointing because Razi's going to do this later on, so hopefully it's all there. We don't know yet. But yeah, like, comment, and subscribe. Give us a message. We'll get you embedded, and you can start to look at how something like an investment round would look like if we were to invest in Hishabee.
Thank you, Rakin, for sharing with us your journey over the last 11 to 12.
No problem.
Yeah, I mean, imagine in maybe the third episode featuring Hishabee, we'll be further with more exciting things to share. So if you
amazing,
if you want
next time we talk, you'll be talking to us from your penthouse apartment in New York, maybe.
I was gonna say that if you want to disrupt how Bangladesh does business, do find out how you can support Hishabee.
Perfect. Thank you. Yeah, we're gonna disrupt how Bangladesh does business. We're just getting started.
Cool.